Hello. My name is Robin Da Vinci, and I am going to talk today about mortgages, the hidden cost of owning a home, and the unexplained tension and trauma behind home ownership, and kind of the myths that have been thrown out there about how you have to own a home. Okay, so let's dig in. The first thing about owning a home is, can you really afford it? And does it really work for you financially and tax-wise? We have been told since I was a little girl, which was, centuries ago, I was told that owning a home is a way to save on your taxes. And so you needed to get into home ownership. You needed to be able to deduct your property tax, your interest, your insurance, open up your Schedule A on your tax return. All of this stuff was told to us when we were young. And I still think those things are perpetrated today to the youth and to anybody who doesn't own a home. That makes them feel badly that they don't own a home. But here's the truth. You can only own a home if you can truly afford it and you're capitalized to be able to do it. Here was one of the problems with the interest rate going down. And the interest rates, I think you could get a fixed at 2.25%. Unheard of. The whole time I owned a home, the entire time, I could never get lower than 6%. The fact that it went to 2.25% was amazing. Now, if you were able to get a 2.25% fixed rate for 30 years, you hit the jackpot. That basically is free money. Nothing else is. If you get in on a variable interest rate and it's going to keep going up, if you get in at something that says you need a balloon payment in 3 to 5 to 7 years, you have to be so involved with the housing market to see if you can do that. So here's the thing. Lenders want to have 70% or less interest in your home. They want you to have 30 or 40% interest in your home. By that, I mean, they want a big down payment. If your house is that you're going to buy is $1 million, they're going to really prefer a 30% deposit because they want you to have the part of the investment that is going to crash. In most cases, when the housing market crashes, it crashes by 30 to 40%. Please note that that is your investment in the house that has taken a dive, not the banks. They do not want to have 100% interest in a house that is sketchy at best or was bought high and then have the market crash and they be in over their heads with your home. So remember that. Why they ask for a deposit? Why do they want 30%? Some will take 20, but why do they want that deposit? Because they want your portion of the investment in your house to take the dive if the market crashes, not their portion. So they only want to lend up to 70%. Actually, they'd be happier at 60%. And if you don't have a great credit score, they're going to want more money up front, which means if you're like the average American, you will not have any money to fix anything once you get in the house. Understand that one of the most important parts of buying the house is that inspection. And you don't want that inspector to be bought by the seller. I know everybody says, oh, the seller has to provide the inspection. Well, let me tell you what happens when the seller provides the inspection. They give the inspector an extra $100, an extra $1,000, and the inspector overlooks some little things. And maybe they're little things. And I'm not calling all inspectors crooked, but they need to make a living too. So they might be pro-seller because the seller hired them. If you don't have the money to get an independent inspector in and the house is a used home, you probably shouldn't buy it. That means you don't have enough money to take care of it once you own it. Remember that there's property tax, insurance, maintenance, if you bought in a gated community, homeowners, and then you have more utilities, more landscaping, more maintenance overall. And you need to understand the home you're buying. So my first step is that you pay for an independent inspector to go into that house and check it out. An acquaintance of mine, the seller sent in the inspector inspector, and he didn't write down that the air conditioning was about to go out. And within 3 months of owning the home, my sister had a $6,000 bill. Now, she's more than an acquaintance, but she definitely had a $6,000 air conditioning and heating bill because it was about to go out, and the seller paid for inspection, left it completely out of the inspection, just checked a box like it was okay. So you have to understand that first things first, don't run into the house, don't buy without inspecting it yourself, don't go just by the seller's inspection, get an independent inspector. Also, understand all the terms of the agreement. How long do you have before you can get out of it? Is your deposit refundable? How much money will you have after it closes to be able to fix the things that are wrong? If there are a lot of things wrong, ask for a credit in your escrow. Do not absorb the former owner's problems. Oftentimes, and hear me clear, when an owner is selling, it means that they know there's a lot of things to fix and they don't want to do it anymore. They probably have equity they're going to get out of the house. They can move on, and you're going to inherit their problems. So pay for your own inspection, get a credit in escrow, have enough money saved to be able to fix the things that are wrong with the house, understand the insurance. A lot of insurers are leaving all kinds of states now. Every state is having an insurance problem. Across the board, insurers are saying, we're not going to go in where there's hurricanes, tornadoes, hail, floods, fires, mudslides, earthquakes. We don't want them. And if you can't get a specialty policy for any of those and your homeowners won't cover it, you need to know that. You need to understand exactly what your insurance will cover. You need to read the fine print. You need to understand, oh, that's not covered. Oh, if you have an earthquake, you need this. And if you think only California has earthquakes, think again. Earthquakes are all over the country. If you need storm damage or window damage, or you need windstorm, or you need flooding, those are separate policies. So you can get a bare bones homeowner's policy and it doesn't cover any of the disasters that happen to you. If you live on the plains in the Midwest, holy goodness, you need specialty policies. Don't assume that your insurance will cover everything that happens to your house. So when you find that house and you pick the neighborhood and you like the school system, or you like how convenient it is to things, you can't go in dreamy-eyed and with only emotion. You need to have the facts in place. And indeed, this house that looks like it's for you may not be. I don't want you fooled. So read your escrow instructions, understand that what part of your deposit you can get back if you pull out, look at the terms and agreements, understand your mortgage. Don't be fooled. Understand if it's fixed, if it's variable, if it has balloon payments. Make sure your insurance covers everything. And believe me, insurance is costly. Understand if you can even get the coverage, or if you have to go to another market. If you have to go to another market that isn't A+ rated, your insurance could go up by 300%. So be careful. Do not fall prey to the scam about insurance. Bare bones insurance means bare bones. It will not cover you if there is any kind of act of God. There will not be coverage. You have to get specialty policies. Understand your balloon payment. Understand the market you're buying in. When you go to buy, has there been a general increase in the value of the homes in the area in case you have to sell? Or is this a depressed area? Are you buying low, but it looks like it will go up? Never buy high in a low interest rate market, because what you're doing is you're buying a payment instead of what you can really afford. If a house is priced too high, but the interest rate is low, you can get fooled into thinking that house is going to increase where it's quite possibly at its highest price right now. So a low interest rate, which are not happening right now, but a low interest rate means that the seller can get a higher price for the house, even if the house doesn't bear that price. Don't be fooled by that. And if you got a 2.25 or a 2.5 or a 3 and it's variable, that means it usually increases up to 2% every time there's a correction. So can you afford that? Can you afford an interest rate at 5% or 7%? Can you afford to have an interest-only loan turn to an interest and paying down principal loan, that's really important to understand. If you buy into a mortgage payment and say, oh, I can afford that payment right now, is your job going to go away? Is your job going to increase? Do you need two incomes? People are not doing their homework on homeowner buying. Don't make those mistakes. It's better to stay out of the market. It's better to not own a home until you have everything in order. And please don't fall prey to the pressure to be a homeowner. It's okay to rent. It's okay to be comfortable what's going on. It's okay that your landlord makes your repairs for a while until you're ready, because home ownership, it doesn't start and end with buying it. That's only the beginning. The rest of the time is a lot of work. Just on a personal note, when I bought a home, I bought it low, but the interest rate was really high. And of course, the interest rate came down. But in that time, I was working so much to keep up the house that I rarely got to spend time in it. And you have to understand too, you want a quality life, and getting in over your head in a home does not usually meet the criteria for a quality life. If it's just 24/7 nightmare, if that's what it is, don't have home ownership. So let's go over it. You want to be well capitalized. The bank is going to only want 60 or 70% of the investment in your home. They want you to have the other 30 or 40%, sometimes 20, but they want you to have that investment, because when housing market takes its correction, it usually goes down 30 to 40% in a lot of areas, and they're still safe and you're the one on the hook for the downturn. Always pay for your own inspection. Get everything inspected. If there are things that are wrong that your inspector found that the seller's inspector didn't find, ask for escrow credits. Make sure you know all the terms of your loan. Do not sign the documents without knowing all the terms of your loan and when increases could come or corrections, or, when the interest rate's going to go up, or whether principal is going to be added at year 5. You need to know that. Don't just assume in 5 years, oh, I can afford that. That's not true. That may not be true. And make sure that you have enough money to take care of the instant work that needs to be done when you step in the door. It's amazing how many things go wrong in the first 2 weeks of owning a home. I have had experience with that, and I speak from experience, so please trust me. Hope this is helpful. I'm more than happy to go into more if you need me to. Please like and subscribe to my channel, and I have a lot of advice about these kind of things. These mistakes are very common, and I want you to avoid them if at all possible. Thanks so much.